1. And welcome everybody to another Smart Money Circle show. I'm Adam Sarhan. With us today is the first in the Smart Money Circle history. We have the CEO of BuildABear and the CFO of BuildABear, Sharon and Voin. Welcome to the show. I'm very excited for today.
Thank you.
So before we begin, one of my companies, just full disclosure, has a relationship with BuildABear. I am a big fan. I am a big BuildABear owner myself. I take my kids there. We've got many happy friends that want to say hello. So I want to thank you for a lifetime of memories, wonderful memories for my family, because it's been absolutely fantastic. So a lot's happened in the last few years with BuildABear. Sharon, can you please tell us what's happening and what's going on?
Well, there has been a lot happening. Just to level set, the company's been around for 25 years now, and Voin and I came about 9-10 years ago. During that time of the last decade, there have been a lot of changes in the environment, the economic environment just the shifts in the digital economy, or mall traffic, or for us, Europe, where we have a presence in Europe, particularly in the UK, Brexit, lots of ups and downs, but most notably, one of the things that the whole world went through was some of the challenges associated with COVID. But through that time, under the underlying promise of BuildABear, much of alluded to, of making memories, that retail side of us, it's an interactive destination where kids at heart can really personalize their own furry friends. But that was the crux of the beginning of who we are as a brand. But those last 10 years, even though we were evolving as a company from the retail side and returning the organization to profitability, we were also changing fundamentally who we were as a company and recognizing the power of our brand. We were literally pivoting the company through infrastructure, digital transformation, brand marketing, entertainment, content creation, to be more relevant in today's marketplace. That is really, though, in so many ways, just an extension of being able to create that emotional connection, which leads back to our mission statement of adding a little more heart to life. Now, through our 500 stores globally, we have international franchises as well, and all of these other revenue streams, including a much more robust e-commerce business, an expanded consumer market, addressable market with 40% of our sales to teens and adults, and a lot of content now, some available with Honey Girls as an example, our own intellectual property on Netflix, and some exciting things that are in the pipeline, from a documentary that'll be out later this year, as well as our Merry Mission animated film. We're just a much more diversified, robust company, and all of that work has led to two of the most profitable years in our history. So 2021, coming out of the COVID year of 2020, was the most profitable year in our history, followed by 2022 eclipsing that year for profitability. So very, very exciting journey, different company now, big opportunities, we believe, poised for the future in new and different ways.
And that's absolutely fantastic. Can you tell us a little about your backgrounds? And I love the brand value. That's really, really powerful. I'd love to know some of your backgrounds, if that's okay.
Oh, yeah. Voin, you'll start, and then I'll add on.
Sure. So I spent, as Sharon mentioned, the last 9-10 years with Sharon working together in different capacities. Both of us worked before BuildABear at Stride Right Children's Group brand. And I also spent some time in the footwear industry with a variety of different brands that I think well positioned us for some of the successes and things that we have done here collectively. I started my career almost 25 years ago with Payless Shoe Stores, where I learned a lot about just the efficiencies. Payless used to run over 5,000 stores at that point in time. So really managing all the detail stuff, the P&L, and understanding how that stuff worked was really helpful as we came here. In addition to that, once Payless acquired Stride Right Corporation, I moved to Boston, where Sharon and I met, and really worked from the brand development and worked with some of the best-in-class footwear brands like Sperry, Topsider, and Saucony. And so really having this strong background from the value preservation that I learned through years at Payless to value creation years at StrideRite. And I think that background really helped us, collectively achieve some of the stuff, in addition with all the experience that Sharon's bringing from her toy years.
Yep. So, and that's a great transition. I did start in advertising and marketing in New York City, a big global agency there in confections. And then after getting an MBA, I went to work for Mattel, which was the number one toy company at the time, worked on Barbie and the Disney business, transitioned eventually to Hasbro, the sort of rival of Mattel. So West Coast, East Coast kind of experience, Mattel being located in Los Angeles and Hasbro in Rhode Island, but there worked on a wide variety of household brands, from Nerf to Super Soaker to My Little Pony, Littlest Pet Shop, the Marvel superheroes, Star Wars, G.I. Joe. I ran the U.S. toy division, so I had very broad scope. And all through that time frame, Hasbro was actually pivoting in a very similar way to what we envisioned for a pivot for Build-A-Bear, in that Hasbro was shifting from a toy company that happened to have a lot of valuable known intellectual property to an intellectual property company that just happened to make toys. And the big transitional moment for that was the Transformers movie, that broke all sorts of records and sort of proved the point that you can start intellectual property and stretch across a lot of categorical areas, as well as a lot of consumer bases, with something that began as a plastic toy, but it creates memories and emotional connection. And when you become multi-generational, you can transition that energy, that power, that brand equity, and monetize it in different ways. So I learned that firsthand by being the head of the Transformers business during that time frame. Very insightful for me, and gave me a lot of I would suppose tenacity and confidence in the ability to take that brand equity that's so rich for Build-A-Bear and transition it. And after that, I did go to StrideRite, and that's where I learned the vertical retail business, because at Hasbro and Mattel and other toy companies that I worked at for years, clearly most of our business is done through big box. We're big wholesalers. So that vertical business was important, but I already knew the cut and stitch business, the import business, because I worked on Barbie fashions years and years ago. So a lot of cut and stitch, a lot of cost reduction. And Voin made a terrific point about that transition of the preservation of value to the creation of value. And that was one of the reasons why I was in a non-solicit, but a year and a day after being at Build-A-Bear, I called Voin and I said, I really would love you to join me here as the CFO, because Voin is so good at that value creation piece. There's one side of accounting finance where you're counting the money. It's another where you're thinking about how to create money. And Voin's a great partner when it's comes to thinking out of the box, thinking about the future, thinking about the evolution of an organization, not just at the reporting piece. That's the past. We have to think about the future. Yeah.
Yeah, no, I love that. I've had the pleasure of meeting both of you, and you have fantastic chemistry, almost like lightning in a bottle at the New York Stock Exchange. And we had an investor meeting there. And I have to tell you, the synergy is just absolutely fantastic. And I love the story, if you don't mind sharing it, when you were up ringing the bell and Voin had to help you with a furry friend, if you want to share that.
Yeah, so that was we're so fortunate. First, of course, you mentioning we're traded on the New York Stock Exchange. BBW is our ticker. And as a toy company and a furry friend company, and something that evokes so much joy, we're asked quite often to ring the bell during the Christmas tree lighting ceremony at the New York Stock Exchange. This happened to be a time when it coincided with our third quarter reporting. And so afterwards, I was, went to the podium, and my PR team had it, that kind of like, there's that meme out there is you had one thing to do and I failed to do it, which was to take the teddy bear up on the podium, because they wouldn't know who, no one would know who I was. This is on national television. I'm just like, hey, with no Build-A-Bear logo or anything. And we had given out, as we often do, teddy bears to the traders that day. And I realized up on the podium when the countdown had started that I didn't have my teddy bear. And I could see Voin, he's 6'6", so he's not hard to find in that sea of people that are clapping and cheering. And I'm yelling down, Voin, throw me a teddy bear, throw me a teddy bear. And this is actually caught on film of that teddy bear flying through the air and me catching it right before the bell starts ringing. It became a really epic moment for us.
Absolutely love it. Absolutely love it. Okay, so you both have storied careers. Sharon, if I understand properly, you joined Build-A-Bear first. You waited for that nonsense to finish. Then you asked Voin to join. Can you tell us about Build-A-Bear's history since you joined, please?
Yes. So when I joined in 2013, we were in need of a turnaround. The company had been contracting, losing money for 8 consecutive years. We lost $49 million in 2012, the year before I started. So we had some work to do. And I'm a big believer, as is Voin, that in a turnaround situation, which we had been together on Stride Right, the first thing to do is focus on returning to profitability. If you can coincide that with the creation of infrastructure to get to the new strategy, that's great. But the first thing to do is return to profitability. So we had a very robust playbook on that, because again, we had just gone through a vertical retailer where that needed to happen. We pulled a lot of pages from that playbook, and we were able to return to profitability pretty quickly, and consecutive years of profitability, 4 consecutive years of profitability. And at that same time, we realized that we needed to, as I mentioned before, participate boldly in the digital economy, right? Mm-hmm. Recognize that we were coming upon, at that time, our 20th anniversary, which is generally that multi-generational pivot where companies either turn it into a flywheel or they lose relevance. And we had to prepare ourselves for those moments. Interestingly, the overlap of the need to build our business in the digital economy when we were known as an experiential retailer, that was a big chasm. There weren't a lot of people that believed we could jump that chasm, right? Like, how will you ever manifest in an internet environment when everything you're known for is about that one-to-one personalized experience in a physical environment? But the unlock happened to be with the fact that we had these older consumers that were now ready to come back to Build-A-Bear. We had such ingrained memories. People remember when they went to Build-A-Bear as a child. They can walk you through everything about it. They often keep those teddy bears for the rest of their lives. Sometimes they have, personalized messages from a loved one inside of these teddy bears. So when we started creating licenses that were more collectible, more affinity based, focused on attracting that older consumer, we really did start to unlock some value that was just heretofore had not been really mined. And that consumer wanted to shop online first. So that was the catalyst for us to really grow that business. When we came, I think when you came to Build-A-Bear, the online business was only about 4% of our total sales. And now it's been up to 20, and now it fluctuates between 15 and 20, depending on the product and the offerings. But that's a very robust piece of business for us in the digital economy, where that practically just didn't exist before. We also realized that we had to change the footprint of retail. Mm-hmm. There was also, interestingly, a lot of encouragement and chatter that we needed to completely shut down the retail side because of these dramatic experiences out there in the economy, like the retail apocalypse, things like that. And the truth is, mall traffic, according to some of the data that we have seen, dropped a cum of about 50% through a 6-year period of our turnaround. That's very, very difficult for any retailer, particularly when you overamp in the physical experience. But what we discovered, this is just pure strategic, tenacious insight, is that the basis, the underlying construct of the success of Build-A-Bear was not about it being in a mall. It was about it being where families and kids go for fun and entertainment and memory making. And that had just changed. Build-A-Bear hadn't changed. The desire to go to Build-A-Bear hadn't changed. The desire for families to have experiences together hadn't changed. That just evolved. So we had to evolve. And we evolved to go to more tourist locations and destinations, and started partnering with everything from Carnival Cruise Line to Great Wolf Lodge, unlocking value by going where the guest, our eventual guest, our profile of guest, has shifted their tendency to go with their families. And so that was a major unlock for us. At the time, 85% of our sales, or of our stores rather, were in traditional malls. And now that's been significantly shifted. So now it's about 65%. So we're much more diversified from a retail footprint perspective, much more diversified from physical to digital. And we've also built out into new categories with outbound licensing, everything from bikes to pet toys. And as I mentioned earlier, getting more and more into content, because if you strip away really what we mean, as much as we were represented in the physical aspect of a furry friend, we mean love, hugs, and memories. And, there's a lot of ways to translate that, inclusive of heartfelt content.
I absolutely love that. And I could tell you from my own experience, when I first went to Build-A-Bear, before we even met years and years ago, my mother, I have young kids, took my daughter and my son at the time, and she bought them, the very first Build-A-Bear we ever got was a Batman for my son. And then my daughter, she bought her a bear, and they absolutely loved it. And
yeah, that's a kitty cat, Adam.
I have to, it's a kitty cat. I call them all bears, but they're not. And
I know these things. Yeah, it's okay.
I appreciate it. I call this a bear as well, and I know it's Bowser from the new Mario movie.
Yeah.
So
well,
I'm very.
But you know what's so interesting about that is you are speaking in consumer speak. And that was a big unlock for us as well. As a matter of fact, it was that when people go to Build-A-Bear, they call them their Build-A-Bears. It's like one big word. My Build-A-Bear cat, my Build-A-Bear Batman, my Build-A-Bear, Bowser. It's always in front of it. And it was that was a trigger for us to learn to separate the place from the brand, which was a big strategic unlock. So we created a brand mark that was just Build-A-Bear, established 1997. And that houses all the other revenue streams. And then the workshop, Build-A-Bear Workshop, became the place, so that our organization would stop thinking just as a retailer and thinking as a bigger company.
Yeah, I love that. So let's have that investor speak, because this is the whole point of what we're doing here, is to be able to take what you're doing and translate it. So let's talk about growth going forward for the brand. Can you please, the TAM, the total addressable market, is fantastic. You've got multiple generations, you've got the entertainment, you've got the retail, you've got the online experience as licensing. Can you speak about the growth from here, please?
Yeah, I want to hand that one to Voin on the specifics, but there's one big sector that I haven't mentioned, which is gifting. And Build-A-Bear is a highly desired gift. It's highly desired to both give, because you feel so good when you give something that personalized. You picked it out. You maybe put your voice in it. You put the heart. You went through the heart ceremony, thinking of the person that you're going to give the gift to. We've built out that sector on our website. We have things like Heart Box and all sorts of giftables. And we've also opened microsites on the website, including the Bear Cave, to find sort of gifts for adult to adult, including Build-A-Bear After Dark, which is really, really fun to have a growing Valentine's business. But that gifting sector is, a multi-$100 billion category, and we are in the early stages, but have done research that that the feedback is very promising on where we can go with that, but have a lot of places to grow. And we just hadn't mentioned that, from the gifting and affinities piece. But Voin, I'll hand it over to you for our future prospects.
Sure. Before I start talking about the future, let me just go back a little bit in the past and talk about some of the things, because I think it's important to really reference and show what we have been able to accomplish, because that's the foundation for the future. And one of those things that really attracted me when coming to BuildABear is, Sharon does this tremendous job of setting up the strategy and vision for the brand and for a company. And, so really executing on some of those things. And again, almost a decade later, we are very proud of the accomplishments that we have made so far. And even some of the things that we have shared during our tenure here, our merchandise margins, for example, expanded over 1,000 basis points. And again, this is something that hasn't happened in any given year. I mean, but it was just this sustained improvement and focus on continuous improvement across the board, all the way from our supply chain sourcing activities to pricing and everything that we do day in and day out. So it's a big team effort to accomplish these things on a consecutive basis and to continue to drive these results. At the same time, our four-wall store profitability, when we got here, it was less than 10% on average basis. Now it's over 25% on average.
Well done.
So these are some really, strong numbers. And, we are very pleased on everything that we can do collectively, both from the merchandise margin, also managing our real estate portfolio.
Mm-hmm.
When you think about, we had to deal with a lot of challenges, from retail apocalypse that Sharon talked about, COVID. During COVID times, we had to renegotiate every single lease in a matter of 3 months.
Mm-hmm.
That's a typical work that we do over 4 or 5 years time frame. And, really working with landlords, because we believe we are part of a solution for mall traffic versus part of the problem. So we continue to do all these things consistently and consistently well. That's in line with our strategy. In addition to that, Sharon also mentioned our web business. It was in single digits when we got here. It's like 15 to 20%. And again, as the stores continue to perform better, that web business has to continue to really work that much harder. And in addition to that, we spent significant amount of time really focusing on profitability and things that are going to help us return back to profitability and continue to generate free cash flow for the organization. But at the same time, we were making investments for the future that we expect to start paying dividends as we move forward. So as we look forward, we provided our guidance even for 2023 fiscal year. After 2 consecutive record years, we are expecting this year on a full year basis, our total revenue to grow 5 to 7%. We just reaffirmed our guidance after the Q1 results. We expect our pre-tax income to be, again, a record 10 to 15% growth in pre-tax compared to prior year. And, we are expecting to open additional 20 to 30 locations, combination of our company-owned or third-party retail locations that are very asset-light. And, we believe that we are not saturated from the store count perspective, both domestically or internationally, and we continue to be in more places where people go for fun and entertainment. And, definitely we like this asset-light model. In addition to that, as we think about future, and, maybe Sharon's going to talk about it in a little bit more detail later from the entertainment perspective. And she mentioned we are super excited about the Merry Mission movie that's coming out, animated feature this Q4. And, this has been one of those properties that was created in early years when we got here, 2014, 15. And, now seeing it to be on a big screen, it's something that we are super excited about. That property over lifetime generated over $100 million in revenue. And when you really think about that property is in our stores for only last couple of months of the year, November and December around holidays, it's that much more impressive. And, we continue to make these investments from digital perspective to continue to leverage technology to help us communicate to our guests, to build our loyalty program, because we believe that's all foundation for the work that's ahead of us. And, we have delivered some of these great results. We have strong cash flows that we are generating, but I think more exciting things are ahead of us.
Yeah, and on that retail front, just to reiterate, in 2013, It was a meaningful number of our stores that were unprofitable. And we're now 25% of our stores were actually unprofitable. And now we don't have there's virtually none. We're virtually 100% of our retail locations are now profitable. And Voin mentioned that important part about not only evolving the footprint to different places, but the growth of the footprint. We fielded some research recently where one of the top reasons why someone doesn't come to a Build-A-Bear is because they don't have one nearby.
Right.
Because we've actually grown our brand awareness and it was already an iconic property. And in the last research round that we did, we're now an aided brand awareness of 95%. But 40% of people are not within a 30-minute drive of Build-A-Bear. So when Voin says we're not overstored, we're nowhere near. Plus, there's a big desire. And there was an interesting and very favorable outcome of shifting toward this tourist strategy is that we ended up being where families go, and they had such a great experience that when they go back home, they want to go to Build-A-Bear and have a birthday party. But we didn't realize how strong that desire would be, and that now we need to be, back in a bit of a strategy of being back in some more localized areas to meet that community need. And so when we're talking about this footprint growth, it's very data driven for us to make those decisions.
No, I love that. I'm looking for, I don't have it on me, but what you're talking about with the retail light, downtown Disney in Orlando, in the Dino restaurant, there's a small piece of it that's carved out, which is Build-A-Bear store, where I have a Dino Build-A-Bear, I don't know where it is. I have dozens. They're all over the house. We've got dozens and dozens and dozens. I mean, they're all over the place. But anyway, there's a big dinosaur type Build-A-Bear that we made down there, visiting Disney during Christmas, during the holidays. And that is what you mean by a retail light location.
Yes,
where
that is exactly what it is. That's actually a long-term relationship with Landry's restaurants. Yeah. And, we created a sub-brand called Build-A-Dino there. And it's been there for quite a few years. Very, very popular, very successful location.
Wonderful. So thank you for that. Now, all of that, of course, is going to drive a lot of traffic back to your stores. Back in 2021, you said you'd open 20 to 30 stores over the next 3 years. And then in Q4 of 22, your guidance was to open 20 to 30 stores in 2022 alone. What happened?
I mean, we continue to, be really focused on growing our store count, because when you have these numbers that we are able to deliver 25% four-wall contribution, why wouldn't you open more stores? Our payback, it's between 1 year to 2 years, depending on the concept. Our real estate teams have done a really phenomenal job of being able to create experiences in a variety of different locations. We can have locations all the way from Carnival Cruise Line to Grateful Lodges to Landry's restaurant to our traditional stores. We have locations from 200 square feet to 10,000 square foot locations that are all profitable. So we believe, based on some of this data that Sharon shared, that there is more room for us to grow. And we continue to stay focused. Again, from my role, managing the capital, from the company perspective, definitely these capital asset light locations like what we have with Landry's, give us more flexibility to open more stores faster. It's less capital intensity, and still as a customer, it's indifferent. They still come to Build-A-Bear and they can get a full experience. And our goal is really to be in more locations, and that's what we are trying to do. And this year, as we mentioned, we expect to add 20 to 30 locations. We just signed more recently a deal with Kalahari Parks, and we are going to have 4 stores with Kalahari, and more exciting things to come to share throughout the year to achieve those goals.
That creativity when it comes to our stores and our store build out team and all the different approaches to the fixtures has been a big unlock. For the first 15 years of the company, there was a basic footprint, which was pretty typical for a mall-based retailer, and that was started in the 90s. But the model needed to be kind of broken apart and rethought. And so now we have, concourse shops that are out in the middle of a mall. We have automatic teddy machines, which are literally teddy bear vending machines that are in airports. We have really ATMs. They're called ATMs, automatic teddy machines. And, and we pushed all of these things through a filter of being brand right. Those automatic teddy machines actually speak to the guest, and they at the very end, the bear actually makes a noise when he goes through the thing. It's like a wee noise and ends up and says, "Open here for hugs." So there's everything that we do. We try to bring that little more heart to life mission, but that's true as we're rolling out now in Six Flags, we're in other water parks, we're in Cedar Fair, and it's just so many opportunities now bubbling up, from the Pro Football Hall of Fame to, which we're also into, the mascot, like the mascot Hall of Fame. So Build-A-Bear is well known and is beloved, and a lot of these partners recognize that we bring something special that's very difficult to replicate.
You want to share the space story too?
Oh, well, in fact, this was not one of the things that, and I'm pretty bold about what I'll put on our list of things to do, our goals to achieve. But Build-A-Bear was also invited just recently with Axiom SpaceX to be the zero-G indicator for the flight into space. And so we created a special teddy bear and named it Gigi because of the zero-G indicator aspect, that when they hit zero-G, they usually let something fly to kind of prove the point. And this most recent flight, it was a Build-A-Bear, a little bitty shrunk down Build-A-Bear, because space is a premium in space. But that's now available in the very special SpaceX that was uniform, that was under really high security. We were I don't know what kind of security clearances we needed to have access to that to make a teddy bear version, but we got it done.
This all makes a lot of sense. It leads to the record numbers and a lot of growth going forward, and that's you don't need a lot of capital to open those stores, if I understand correctly and I hear you properly, and the margins are really high because there's existing traffic and you don't have to worry about mall traffic and all that fun stuff, plus the online, plus the entertainment. So let's speak about the online component a little bit. Can you share a little about that strategy and growth going forward?
Sure, I can start, and maybe Sharon can add some more. But definitely, as we think about online business, we believe that's a big opportunity for us, especially in gifting arena. We talked earlier about our ability and investments in technology to really better understand our guests and have different journeys through the platforms that we are creating, that we can market and communicate to them in a more constructive way. I think it's a big benefit for us. We have enormous database, first-party data that we are leveraging to directly communicate to our guests. And so we believe that, our gifting business can be more than just plush. And we've been, dabbling in some of those arenas, with different products. We are still doing some testings and learnings based on what can be out there. But definitely, we believe this is an opportunity that could be, many times the size, where we are. But again, this is something that, requires investments, that requires, focus. And, as we have done over the last several years, we are trying to find that right balance to continue to extract value from the existing systems and processes and product, but at the same time, we are looking to make investments and continue to grow that business beyond what it is just today.
And I think that really points toward an element of the strategy that's critical to understand. That e-commerce business and our stores is just a part of a larger ecosystem. When Voin speaks to the first-party data, that's largely generated through email addresses that are provided to us in our stores, or being engaged in our loyalty program. where we have a collective between the two over 25 million first-party data contacts. That, you know, and the unlock there is journeys specifically related to what they purchase, what they want, the sharing of information of birthdays or upcoming events, so we can push out very relevant communications and offers, the transition of guests between online and at store, the opportunity to be a part of us for birthday parties and memory making or Girl Scout parties, all of that family kind of ecosystem. That's important not only to have a brand like Build-A-Bear that's at iconic status, but to be also noted as a highly trusted brand, which we are, is a really important piece of how we can build the business in other revenue streams, because we have access to and the trust from our guests to say, hey, you might enjoy the Merry Mission film, or hey, do you want to watch the documentary, or hey, do you want to, Honey Girls is this, this, and this. So when we engage with our guests with this, and we also, this was a part of this proprietary research that we recently completed, the engagement across multiple touch points with us, whether it's entertainment or online or in the stores, that's a much higher value guest. This is not an unusual data point. That's true for a lot of branded companies. But the affinity that then is generated from that might be a little bit different from some other companies. Examples of the affinity is like for our Honey Girls line, which we launched that line multiple years ago, 2015, 2016, and created a relationship and then launched the movie in 2021. And now that's been available on Netflix. The data shows that when someone engages with the film, their likelihood of, you know, being more engaged with the brand goes up significantly. And I think we've shared we've shared with you, but also in the past, when we got here, our dollars per transaction were around $35.50, right? Now our dollars per transaction are over $50. And but when they're engaged with one of these properties, like Honey Girls, the dollars per transaction jumps up to $75 to $100 per transaction. That's the importance of creating that entertainment relationship. And that's why we believe the creation of a total ecosystem of the place and the experience. So the place introduces you to another brand, another experience, another category, another reason, and that other reason encourages you to go back to the store and experience it again. So it's a complete circle of value with the consumer in the middle.
No, I absolutely love that. So you've got growth from stores, you've got growth from online, you've got the entertainment business, and that's driven by your brands and third-party brands. Voin, maybe you can touch on your guidance and what gives you confidence that you can maintain your margins going forward. I know gross margin was 40% just a few years ago. Now it's 53%. Can you please let us know why that's sustainable?
Sure. And again, you know, ties back to what we talked about earlier, you know, like it just this sustained focus on continuous improvement. And, you know, like when we also mentioned maybe at one of the conferences a few months ago that even this year we would expect, everything else being equal, to see additional margin expansion due to the fact that we are going to see benefit from lower freight costs compared to the prior year. So when you look at last year margins that we were able to achieve, that reflects significantly higher freight costs. And we said that's to a tune of 100 basis points. You know, this is one of those areas, margin, that, you know, since we started here, that was tremendous focus on this particular line item. And across the board, sourcing initiatives, costing initiatives, working with our factories, working on transportation, working on the promotional cadence. We are focusing on every link within supply chain that we can manage and optimize and maximize. And we believe, you know, there is more room. I'm not saying like it's going to be like what we have been able to achieve, thousands of basis points, but definitely, you know, like our goal is every year to be better and to continue to expand our merch margins. And, you know, that's reflected in the guidance that we have shared this year.
Mm-hmm.
And that's again part of that 10 to 15% pre-tax growth contribution on a full year basis.
I think too, one of the things that we're very proud of as a executive team is that not only have we, guided this organization through a lot of change and through some of the difficult times, but we've, as I noted before, we've evolved to be prepared for an entirely new future state that's reflective of the way the guests and the consumer and the world is changing, but also the way our brand has been changing. But all through all of that, whether that's a retail evolution of footprint and strategy, the acceleration of the digital transformation, the creation of entertainment and content, and the recognition of that as a tool for us that creates power and relationships beyond that one-to-one relationship that we create every day inside of our stores, is the ability to simultaneously return value to shareholders. And you see that in our stock price appreciation, but also in the form of special dividends and buybacks. If you'd like to expand on that.
Yeah, I mean, we've been very generous in returning some of the money to our shareholders over the last couple of years. As of the time we filed our most recent Q, it's over $80 million that we have returned over less than 2 years. And again, as Sharon mentioned, a couple special dividends, and we bought almost over like 10% of our outstanding shares back during that same time frame. So we've been really active on that front. But at the same time, as we continue to generate free cash flow, and we are continuing to make investments in business, because again, having these results and thinking about the future and the growth, we gotta continue to reinvest. And if it's opening stores or looking at some of these different initiatives to help us really elevate the whole brand in different channels, because even some of the things that Sharon talked about, making these investments, in entertainment, in store, she talked about a product and like Honey Girls movie that we had last year. When you think about that story, we are selling over $100 in dollars per transaction when people are engaging with that story. Mm-hmm. And what that really means, because kind of like I'm also trying to connect it back to the question also on the margin that you asked earlier. We did raise some prices and did some things over the last several years to really offset some of the inflationary pressures, but people are coming and still spending that $35 to $50 total dollar per transaction spend. It's both higher prices and also higher units per transaction. So people are coming more and buying more at the higher prices. In addition to that, we are still accessible for many people. And we have Pay Your Age program or Count Your Candles that started with Pay Your Age Day in 2018. And so people that are celebrating their second birthday can come and buy that special bear for $2. And that's our biggest acquisition tool. So it's really important for us to continue to fund that first party data and to build our bonus club program. And at the same time, tell these comprehensive stories that are going to continue to elevate the brand, continue to generate free cash flow, and then we can find ways to return some of that money back to shareholders and then also to reinvest back in the business.
Yeah, no, I absolutely love that. And having the people come in, I think, is next level genius, and giving them the price of the bear based on their age. So they come in the first time, and then of course on the back end, it's going to plus their friends and family and birthday parties. It's absolutely genius. So and that also leads to a massive asset that you have, which are just names and emails of customers and loyal enthusiasts, not just customers, people that just love the brand, super fans, and so on and so forth. You've generated a significant amount of free cash flow last year. Should that continue going forward? And what do you do with your free cash flow?
I mean, like we touched on some of that last year, we generated nearly 50 million in free cash flow. We haven't provided specific number around that metric, but we also shared that we expect our pre-tax income to grow 10 to 15% versus prior year, our tax rate to be about 25%. So people can back, we also guided that our CapEx is going to be about 15 to 20 million. So again, looking at all that stuff, it should be similar level, a little bit higher compared to prior year. And so definitely as we think about that stuff, the first, it's investing back in the business and continue to return money to the shareholders, and finding the balance between the two, because we believe there are many more growth opportunities for us. And, there is a different horizon on some of those, but definitely, as we mentioned about the store count expansion, opening 20 to 30 new locations does require some capital investments. We are making investments to upgrade our POS systems, continue to make investments in our digital transformation. And at the same time, we've been active in repurchasing shares. And I think this year we spent almost $14 million in share repurchases.
With a meaningful percentage of buyback of our total share count.
Yeah, over the last 18 months
Yeah.
or so, yes.
And I also believe that that what you mentioned, Adam, of like the diversification of the brand, the access to this first party data, the fact that we're building out like this, ecosystem where we can move people from, entertainment to online to in-store, and then the recognition that we're actually now, from Horizon perspective, we're participating in big, robust categories, not just toys and not just mall retail and not just kids. It's toys, gifting, collectibles, affinities, entertainment, malls, tourist locations, e-commerce, gaming with our Roblox game where we launched last year, 9.5 million players already, as well as adults, teens and tweens representing 40% of our sales, and for many, many different occasions than there had been in the past. And that is not to mention the opportunity for us in international. So we're not participating, for example, right now in continental Europe. There's not a Build-A-Bear in continental Europe, to give you an example of where we think the potential there could lie. That's a very typical place, of course, to go for a U.S. company. We are in the UK and Ireland, Canada, but we have significant runway for exploration as well as expansion into other countries at this point. Maxine Clark, our founder, used to say, a teddy bear hug is understood in every language, and thus far we believe that to be true.
Well, she's so right. And also, Sharon, separately in your book, I know you have experience, which is, by the way, phenomenal, and I strongly recommend it. I've got notes all over the place, but I know reading the book that you have experience living in continental Europe, in Paris, I believe, with Mattel. Is that correct? So
that
yeah,
is correct.
I'm sure that's going to be a layup for you when you decide to go into Europe and expand.
Nothing in Paris is a layup, but
Fair enough.
He's from continental Europe, right? So he grew up in Montenegro, and I actually also went to school in Belgium and then did live in Paris for a year working with the Disney business unit, which was a terrific experience.
Well, yeah, that was going to also bring Voin in and say that the European background there should be a 1-2 punch for both of you. It should be a no-brainer, so to speak, from a intellectual standpoint. The practical standpoint, whole different story. But I love the growth potential.
You got to have good partners.
Yeah,
that's the key.
Sure.
Yeah,
100%. Okay, so that's a tremendous amount of coverage. Let's shift gears for a second. Talk about the macro. Can you please remind us and remind the audience about the toy industry and how it performs during times of economic uncertainty, please?
Yeah, so that's a long history, and it tends to be comparatively robust, which you would see if you looked back even through COVID. The COVID times, the toy industry outperformed, plush actually outperformed, and games outperformed. It's, I think that it's linked to just the need for comfort and joy and experience and together time. It makes a lot of sense. So that's an area that has, it does have its ups and downs, but it tends to perform well comparatively in economic downturn. People also tend to not choose their children as the first budget cut.
Right.
So, all of us have kids here, so yeah. We all get that. And that's, you just want to be able to do something special, even if you can't say go to the big theme park, which now we're at a whole lot of those. But, in many ways, going to Build-A-Bear is like is that like, you know, it could a super special experience for them where you just had to get in the car and drive down the road a little bit, and they're just as happy for that one day. Yeah.
But just to add to that piece, when you think even about our businesses, some of these challenges, like when you think about 1/3 of our business is related to birthdays. And guess what? People are going to celebrate their birthdays with their kids every year.
Yeah, that does not get pushed off during an economic downturn. Let's just not celebrate your birthday.
They'll celebrate 3 months later. That doesn't work.
Don't worry.
Yes, seriously.
And, you know, same thing around the graduations and holidays. So, you know, there are some of those things, you know, that, you know, there is a business to be had every year. But, you know, definitely, you know, we tend to stay focused on things that are within our control and really driving on those to mitigate some of these challenges, because every year there is something that's going to come up that surprises you. But, you know, we got to stay focused on things that we can control. And we have done a pretty good job managing some of those things through COVID and through Brexits and all these different retail apocalypse things that we have dealt over the last decade or so.
I think that it's an important note too here. It's certainly intertwined with some of this discussion. Voin mentioned that we renegotiated all of our leases. One of the reasons we were able to go into those lease negotiations with a position of strength was we have data that implies, you know, 60-70% of the sales in our stores, those are planned excursions. This is a situation where, you know, clearly if it's a birthday, that's on a specific day. They know what their kid wants to do. We're doing this, or there's a, you know, Girl Scout party or an event or an experience or something going on in this kid's life or an adult's life where Build-A-Bear is on the list. This is not a situation where families are all getting in the minivan and just driving to the mall and they stumble into a Build-A-Bear. This is a situation where they're getting into the minivan and driving to Build-A-Bear.
100%.
And they end up in the mall.
Right. Yeah. No, that makes perfect sense. And I love what you're saying too. It's people aren't going to stop saying I love you during economic downturns, more or less. So okay, that's fantastic. So this year looks very good. Earlier you mentioned your Merry Mission movie's coming out later this year. Is the movie part of your entertainment strategy? Can you speak a little bit more to that? I know Reese Witherspoon, you've got some deals going on, and just expand on that, please. Yeah,
so the roster that's pipelining right now is we have a documentary that will be out later this year. The goal is October, looking good, with an award-winning documentarian, Taylor Morden. It's called Unstuffed. So really cute, a Build-A-Bear tale. It's really the story of the ups and downs, the goods, the bads of the first 25 years of Build-A-Bear. It's incredibly entertaining, if I might say so, and star-studded, star-packed, because everybody loves Build-A-Bear. So that's coming, a lot of fun. You know, more for an older audience, like documentaries are, but completely, of course, as it would be appropriate for a kid to watch, and really, really a fun journey. The second is the Merry Mission film. It's Glisten and the Merry Mission. Glisten is a magical snow deer that has been in our line since 2015. And she often is our #1, if not almost always, actually, our #1 selling item at the holidays. And the crux of the story from the beginning, which we launched through our stores as a goal to create a destination and a reason to come to Build-A-Bear before Christmas, not just get those incredible gift cards, which we sell a ridiculous amount of gift cards. And as an aside, that week after Christmas is one of our biggest weeks because everybody comes in with their gift cards and nobody brings back their teddy bears. So our returns don't exist.
Right.
So, which is wonderful. But they do come in with gift cards. But we wanted people to come in and make Build-A-Bear part of the tradition, and it worked. And so you get the reindeer and all these characters and the dilemma that they're trying to solve, and they have to solve and save Christmas, is that the nice list is too long. Glisten helps them with this, and of course teddy bears also help them with this problem. It's really, really cute. It stars Chevy Chase is Santa. Billy Ray Cyrus is in it. Dionne Warwick sings a song for us. Julia Michaels, who's amazing, is starring in it as well. It's just really another star-studded, packed, just really fun. And it's because they love Build-A-Bear and they love the story. The story is really a story about what we call bear leaving. But the pipeline does include a film that's a reimagination of Goldilocks and the Three Bears with Hello Sunshine, which is Reese Witherspoon's company, as well as a number of different things from live action to animation that's coming, and very, very exciting.
I love it. So you've got books, you've got games, you've got movies, if I understand correctly, and all of that is just going to continue to grow earnings and revenue going forward as new profit centers for the company. Is that correct?
It's a combination, and we did also just announce a very robust deal with Macmillan Publishing, very exciting as well for books. Thank you for mentioning that. But in some cases, these are about the marketing of the intellectual property, the access to the creation of a relationship, more than them being revenue generating upon themselves. But that's always a tremendous possibility. But we logicked our way into this strategy based on a lot of best-in-class companies. We certainly didn't make up the idea of mashing up toys and entertainment, as I alluded to earlier, and that could lead to significant success. But we rationalize our way into this, being prudent with our funds, as that it is a meaningful decision strategically, even if all it was a marketing tool.
Yeah, no, it's genius. And you said the engagement too, the dollar spent per audience
Absolutely.
is just through the roof. Okay, I love it. So maybe to finish, anything you want to say about your long-term vision?
You want to start, Voin?
I mean, we are excited about the strategy and vision that we set up, or Sharon set up many years ago, and we continue to execute on that, and all these pieces are just part of that vision. We believe this company should be much bigger than it currently is. That's part of the reason we came from all these multi-billion-dollar organization to help on this journey. We are excited about future. Definitely it's much easier to talk about the future and making these investments when we have healthy and solid balance sheet and being able to make the investments. We are definitely in a different situation than we were when we started, and so we are happy to continue to make these investments, to continue to execute on all these things, and so more to come. We haven't provided more guidance beyond this fiscal year, but we definitely think there is more to come, and more for us to share in the future.
Absolutely. And in so many ways, we are just now, because of a lot of external unforeseen shifts, gotten to the crux of the vision, which is a really well-run vertical retail, which we already knew we could do. Throws off a lot of cash, right?
Right.
And you have to have a plan on what you're going to do with that cash that generates more opportunity and expansion, right? And we had built that whole infrastructure and opportunity and pressure tested all of that while we were cleaning up the retail side and evolving the retail footprint. So now we're at that place with our free cash flow is in a robust place where we can start to lean into these bigger categories, bigger opportunities, and make key investments that are more future focused. We still believe we're at the beginning of this process, right? And I don't mean the beginning of the turnaround. We're on solid ground now. This is an opportunity for us to think about the future in a different way. We have a fabulous team, a new infrastructure, a proven strategy that has also been pressure tested when we did all this research. That was one of the key findings that we were interested in, really wanted to know, both for ourselves and the sake of the board and the investors, is this the right move? And that data was yes.
No, I absolutely love it. Hats off to both of you. Phenomenal job to the entire team at Build-A-Bear. This stock, in my humble opinion, is extremely undervalued. It sounds like you're at the beginning of that J curve where you've got, it almost reminds me of Amazon, how Amazon had retail and then they announced AWS, the web services. And then over time, AWS eclipsed the retail business from a profitable standpoint revenue. So it sounds like this is a tremendous, I mean, massive growth going forward. Thank you so much for coming on the show today. Hopefully we'll have you on again soon. And everybody, the stock is, the ticker is BBW, the company's Build-A-Bear. And the best way for them to get in touch with you, if anybody has any questions, they visit the website, or how should, on final note?
Yeah, visit the website, and like if there are some questions, please, our emails, like are available, and please send us a note. We would love to hear from investors and our guests, and
click on the IR section. Yeah.
Beautiful. Well, thank you
Adam,
so much.
thank you. And thank
Thank
you
you,
so
Adam.
much. We appreciate it.
Absolutely a pleasure.